Hey everybody, this is Brant from Wolf on Wall Street Trade with a quick video update. I think last weekend I mentioned I want to do a live event and I was prepared to do that, and I checked into it. I started a little bit of a live feed and I didn't realize with YouTube when you go live all you get is your webcam. I didn't have an ability to share my screen, share charts without another program, OBS, which I got and started working on that. But that's a whole thing unto itself, learning that, spending a good part of the week doing that. So we are going to do that live event. Got a lot of good feedback on that, and I think it'll be fun to do. We can do some question and answer stuff. So it's definitely on my to-do list. Just basically getting that software so I can share charts with you and you're not just looking at my ugly mug. So I would encourage you, the way I do these videos is kind of just like a running diary for members and subscribers to my website. Of course, you know a lot more of what's going on as we go through it in the week, but at the end of the week, I'm just kind of doing a running diary. So if you go back, I think it's always useful if you go back and watch the prior week's video. But if you don't have time for that, I understand, but it just gives you more insight into how things are developing in the market. Things just don't happen out of the blue. I always say changes in tone or changes in character, which are subtle, always or almost always precede changes in trends. So something that we expect to come, we get hints of that long before it actually does come. So what we're looking at now is the S&P 500 as it looked at the end of last week, when I did last weekend's video. So we had this real dull kind of Christmas holiday range into the new year. You can see this range right here, basically between 3,800 and 3,900 in the S&P, ended right at the top of the range, but there were some things that were already standing out. Seeing a lot of improvement as soon as we entered into the new year right here around January 3rd. One of the things that stood out to me was the S&P equal weighted index. This is the benchmark index, which is cap weighted, but the equal weighted index was already breaking out. And here you can see the S&P equal weighted index, and it's got more of an ascending triangle. Even though this isn't the right place for an ascending triangle, it's acting more of a base than a consolidation pattern. But instead of that kind of lateral range going sideways, we have higher lows here. So this is a bullish, basically kind of like tension of a spring winding up. And you always know when they come to an apex that they're getting close to breaking out. And when they break out about 2/3 of the way to the apex, if we were to extend these two trend lines, that's usually a pretty strong breakout. So as of last weekend, this was one of the things that was already happening. We're seeing a breakout in the S&P equal weighted index, which meant at that point that the mega caps weren't pulling their weight, but that's something we were looking for to happen for one other reason, and that reason was a really heavy mega cap heavy sector. The communication sector was one of the first sectors to break out. So again, you can see I have this backed up as of last Friday, the 6th. So last weekend's video, and here is the communication sector. Again, instead of like a real flat lateral range, we have a little bit more of an ascending triangle, higher lows over here, resistance right here, and there's the breakout. I mean, this broke out well before the S&P, even before the S&P equal weighted index. So this was starting to show a change in tone or a change in character in those mega caps that are so influential, heavily weighted, and have so much ability to move the market. Here's the Dow Jones Industrial, again backed up to the 6th. It was starting to break out too above this range. So as we're entering the new year, we're seeing subtle improvement in a lot of areas coming into this past week. Another one is high yield credit. A lot of institutional traders will use HYG because it's so deep and liquid as a proxy for S&P futures. So I always watch high yield credit, and you can see the S&P and HYG here in white. And into the end of December was just ugly month, You can see high yield credit down here was leading lower. But again, as of last weekend's video, and I pointed this out, what we're seeing is the S&P basically holding around the 3,800 level, right? It had tested that like 9 or 10 times, held support, but look what was happening with high yield credit. It was making higher lows over here, and it was starting to lead higher by the end of last week. So this is a window into what institutional money was doing, and this was showing improvement as of last week, even though the S&P quite hadn't broken out, right around that 3,900 mark, in that range between basically 38 and 3,900 from December. So I think the gist of what I said was that I would have liked to see, I wanted to see mega caps show some leadership coming into this past week, and we got hints of that from the communication sector breaking out. And one of the things I said that would need to happen was bond yields would need to come down, and that would be largely dependent on what happened with this past Thursday's CPI report, the Consumer Price Index. So mega caps have been really sensitive to yields. Yields go higher, the mega caps have gone lower. So we needed yields to come down lower. That means we needed a weaker CPI report for that to happen. I use technical analysis in a very different way than what most people would call technical analysis with, technical indicators and stuff. I look at different asset classes and how they behave because they all kind of connect to one another. So one of the other big things last week was semiconductors tend to lead the technology sector. They're part of the technology sector, but they're a very sensitive part. They tend to lead. And what we saw last week was semiconductors leading the technology sector by a huge margin. They were up over 4%, while the tech sector was up 0.2%. So that's what I call a leading market signal, or a message from the market. So it's a very different way of looking at the market than your standard technical analysis, where you're looking at, MACD histograms or a lot of moving averages or RSI and stuff like that. So that's kind of what I do. That's what a lot of my members have known, and I teach these things as I go along, because I'm not the kind of person where I want to make you dependent on me for my analysis. I want to teach you the concept. So instead of saying, here's a fish, it's like, here's how we fish. Here's how I look at the market. So with all that said, let's just see what happened this week. Here's a daily chart of the S&P 500. Here's Monday, the start of the week. This is a 50-day moving average in yellow, the 100-day in light blue, and the 200-day in dark blue. S&P up 2.67% for the week, so had a really nice week. And you can see some very strong daily candles here, and ended the week right here around the 200-day moving average. The NASDAQ 100, remember I said I want to see those mega caps really perform. Up, 6 days in a row, up over 4.5%, almost doubled what the S&P 500 did. And we haven't seen that in a while. That means those large cap tech stocks and the mega cap stocks this past week did what we were looking for. They performed. NASDAQ closing up above its 50-day, up just above its 100-day. But the relative strength there was what was important. The Dow had a respectable 2% gain. But the Dow has been leading this entire rally since the October lows, up over 20%. I talked about that, how the financial media was saying it was in a new bull market, and I didn't buy that. Anyway, what I've been looking for was the Dow, that has been the leader, to start to come down and be the laggard, and the NASDAQ and the mega caps to take over. So the Dow was up 2% on the week, so NASDAQ more than doubled that. So what I've been looking for to happen actually happened this week, and then we had small caps that were on a tear to the upside. And like the NASDAQ 100, up 6 days in a row and up over 5%. This is largely because of short covering. So they have no mega cap exposure, but my most shorted index is mostly small cap stocks, and we saw a lot of short covering, which is one of the things I said last week. When the S&P moves above 3,900, you're going to see more shorts cover. We got a massive short squeeze. I think Goldman Sachs' most shorted index was up 16% on the week, so huge short squeeze. And let me just show you a post from Monday morning of this past week, which was the 9th. So I'm going to show you a post Monday morning for my subscribers, and hopefully you can see this. This is the early update. It's the second post I do. It's the first post I do when the cash market is open. I do one pre-market. So you can see 11:03 a.m. the early update. I'm saying, as soon as we saw the open on Monday, mega caps were finally exerting some leadership. We're seeing that first thing Monday. And then here is what I wrote next. And in case it's not clear, this is the same post, that early update. I just kind of grayed out a little bit of it. But I had this chart, the S&P 500. This is Monday morning, and I said that my conservative measured move for the S&P 500 came in at 4,000. So you can see where we were. This is the measured move I had on this chart for our subscribers. And let me show you the S&P 500 as of the end of this past week here. So here it is as of Friday's close. We can see popped above 3,900 right there on Monday, pulled back a little bit, right up to 4,000 on Friday. As a matter of fact, let me zoom in on a 1-minute chart. So about 3:30 or so, it hit that measured move at 4,000 exactly. I mean, here's where it hit that measured move right on the nose. Now, these aren't guesses. This is not like, well, I'm just thinking, we could probably hit 4,000. These are measured moves. They're based on the price action. So this is, again, something that we do. We look at the price action, what the price action is telling us, because the price action is just a view or a representation of mass psychology. That's why it tends to be predictable and we can get these measured moves so accurately. So what's the most probable thing that happens once a measured move is hit? The most probable thing is that we get a price consolidation. And that doesn't mean we can't see more upside. We often do. But this would be the kind of place that we would expect a price consolidation. Like I showed before, we have the NASDAQ 100 up 6 days in a row. We have small caps up 6 days in a row. I think Dow Transports too, which outperformed Dow Industrials. That's another leading positive signal. Up, 5 days in a row. They're down just a little bit on Friday. And we have some breadth indicators that are basically short-term overbought. Plus we have some levels that are in the area, like for the S&P 500, we have some technical levels like the 200-day, plus that 4,000 level right there for the NASDAQ 100. We have the 100-day. So these are areas that are typically going to act as a speed bump. And if you're already hitting a measured move and you're running into these, again, it's just an ideal place to look for consolidation. And a consolidation can be very useful because we can see what the market signals are doing while price consolidates. Are they improving? Are they deteriorating? What does the consolidation tell us about when we can expect a breakout if it's a bullish consolidation? And what the measured move is, so we can get a lot of good information from that. Plus, you don't want a market to get too overbought because what tends to happen, it's like almost going parabolic. It's not building support structure and shaking out weak hands as it goes up. So it's just like kind of building a high rise. If you want to build higher, you have to build a strong foundation. You have to support the floors along the way as you go up. So a price consolidation is not a bad thing at all. Also, you might remember in last weekend's video, I said that yields needed to come down. They broke this uptrend here. And the reason they need to come down is because the mega caps don't like these rising yields. I can go into further detail about it, but it's not important. It's just a correlation that's very strong. Yields did come down. So here we enter the beginning of the week, come down to this former bear flag. It was kind of invalidated, but the trend line is still active. You can see right here, we get a little bounce, and then we break down below this trend line. So this trend line is important, even though it's not a bear flag anymore. It is important, and towards the end of the week, we see yields just kind of bouncing to back test this trend line. That also suggests that a consolidation phase is probably likely because we're seeing a little consolidation in yields as well. Plus, the banks just kicked off earnings season on Friday, so the market may want to kind of just sit back a little bit and see what the earnings come in, what the forecasts are. And of course, if you didn't know, we also have a holiday shortened week, so Monday the market's closed for Martin Luther King Day. Now, the reason yields came down was because the CPI report came in again softer. So that's 3 in a row that have been soft. That is telling us that basically inflation's still high, but it has peaked. And we got signals of this in our copper gold ratio indicator back in June. So commodity inflation had basically peaked back then. Now we're seeing it in all kinds of other data. Now the services section was still hot, but that is really heavily weighted with real estate. And the real estate component is like a really bad lagging indicator. It lags basically what's happening real time by about 12 months. So this decline in yields that is helping the mega cap stocks, helping the NASDAQ 100 is because in part we got a weak payrolls report when it comes to the wages, which the Fed has been worried about. And now we get another CPI report that's confirming that inflation is breaking. Now, as far as market signals, as we head into next week, they are still very strong. So we still have high yield credit leading the S&P 500. We'll see how that pans out in the week to come. But this is a very strong signal. It was this area here where I was talking about a change in character, and we see a change in trend since then. So that's very strong. Here we have the S&P 500, and in blue we have small caps, and they are normalized as of this point. So you can see small caps are leading the S&P 500 higher. Now small caps, again, don't have that exposure to the mega cap stocks, but they do tend to lead risk sentiment. And the reason they have been doing so good is because of a massive short squeeze. Here is the S&P 500, and my most shorted index. This is the 4,100 level where the S&P failed. Here's the 38 to 3,900 range. And what I said was once S&P crosses above 3,900, you're going to see shorts cover. That's what we're seeing here, a major squeeze. And guess what? There's still a lot of potential, still a lot of upside potential for more short squeeze activity. If we look at 3C, my money flow indicator on the IWM's chart, you see really strong confirmation and even leading higher here into the end of the week. That's another very bullish signal. Over here we have the tech sector, and over here we have the semiconductor index, the SOX in blue. And this again is a chart that's normalized, so you can see the relative strength right here starting to pick up into the start of the new year. Change in character, right? Change in trend. And we can still see semis outperforming the tech sector this week, I think by about 200 and something basis points. Strong outperformance, that is a leading positive market signal. This is what I'm talking about. My kind of technical analysis is not about, MACD histograms and stuff like that, or moving average crossovers. I'm looking at how different assets perform and what the message of the market is. Over here, another leading signal, the Dow Industrials and then the Dow Transports. Again, this is normalized, so they both start the same percentage right here. And we can see, again, another positive market signal from transports. And more importantly, what I was looking for was for mega caps to outperform. And if you look at the mega cap index this week, it outperformed the S&P equal weighted index by almost 100%, did almost twice as good. So that was something we were looking for. Saw the first signs of that with the communication sector breaking out the prior week. That's very strong, and that's helped by yields coming down. As far as market breadth, in October, November, we had really strong market breadth. It fell off a bit in December. This is one of the breadth indicators I track. It is the percentage of NYSE stocks that are trading above their 200-day moving average. So back here, when the market was at an all-time high, you can see where they were in this white line here, this indicator. Look at where they are right now, even though the S&P is nowhere near that all-time high. So this is a lot of strength that we're seeing in internals, in participation. That's why we saw the S&P equal weighted index, the SPEW index, breaking out before the S&P. So what we're seeing is really broad participation. And now we're also getting the very influential mega caps that are starting to finally show some leadership. So there's a lot of potential for the market to do well for a little bit longer here. I don't think that this is the new bull market starting or anything like that. I think it's the pivot from inflation and the Fed raising rates to fight inflation to that kind of pivoting to a little softer stance, not rate cuts yet. But the next thing we're going to deal with is recession, and then the market is going to struggle with that. But for right now, this is what we're seeing, and it's looking strong. Basically, since the end of the COVID crash, we've seen a really strong inverse or negative correlation between stocks and treasury yields, and also between stocks and the dollar. So another big development this week was because of that weaker CPI report, the dollar's basically been reflecting Fed policy. We basically got the dollar breaking down, and if you've ever heard of a death cross, it's like the 50-day moving below the 200-day. It's kind of a trend change. Well, here's a daily chart of the US dollar index. Here's the 50-day in yellow, the 200-day in blue. If we zoom in a little bit, you can see the dollar breaking down, which is very helpful for stocks. It looked like it might not be right around here, right before we went into this past week, but with the weaker inflation data and all that, it did make a lower low, which is very supportive for stocks. And then we also see this death cross, which is basically telling us that there's a change in trend here. This is the Fed raising rates, inflation much higher. This is why the dollar's moving up. Now we're seeing that change in trend, which is reflecting peak inflation. So for all the reasons I mentioned earlier, with technical levels, moving averages, speed bumps, market a little bit overbought short term, and a measured move being hit, what I'm kind of expecting, especially with earnings season starting, is the market to consolidate. And what we're going to be watching for is what kind of consolidation. Is it a rectangle? Is it an ascending triangle? Is it a bull flag? Is it something that just doesn't look bullish? What are the market signals doing as we see price consolidate? Because I think that is the highest probability that we consolidate right in this 4,000 area. Then we'll have a better idea once we see what price is doing, what kind of consolidation. We might be able to time the breakout if it is a bullish consolidation. We can also get our next measured move. So remember how accurate that measured move from Monday morning was. We're right somewhere in this level, and I said we're going to hit 4,000, like right on the nose Friday afternoon. So this is what I do. This is what my subscribers get all week that subscribe to Wolf on Wall Street. And as I've mentioned before, I do have a new website that's going to be coming out. It's taken a little bit longer than I had hoped, but the price will be going up on it a little bit for new subscribers. But if you are a subscriber to Wolf on Wall Street, by the time that new website goes live, you'll be grandfathered in at the same price. I have had my subscription since 2008. So check it out. You can see what we do by watching these videos. And again, I recommend that you go and watch the past ones and just see what I said I thought was going to happen, why, and see what happened. Like I said, I'm not here to make anybody dependent on me. I want us to all be successful together. I want to teach you these concepts so you can apply them for yourself. I think I have quite a few members who've been with me from the start, well over 10 years. They know everything I know. I suppose the only reason they're with me is because I have all day to watch the market where they may not. But check out the website. Otherwise, don't forget to subscribe to my videos down here and hit the alarm bell so you are notified when new videos come out. And if you like the video, please give it a thumbs up. If you have any questions, comments, please leave them in the comments section. I'm more than happy to try to get to those and answer them. And I will be doing a live event, and I will let you know as soon as I get this kind of screen share software figured out. So everybody enjoy your weekend. Remember that the market is closed Monday for Martin Luther King, and then we're going to kind of jump into earnings season. So subscribers, I will see you early next week. Everybody else have a fantastic weekend, and I'll see you next weekend.